Thursday of this week, Kim Croissant was interviewed on Power Lunch on CNBC. And in the last couple of sentences, he said something to the effect that the Fed is selling calls to the market, which is suppressing volatility. Today in this video, I'm going to share with you my thoughts of what he means by that and how it is affecting the overall markets and where we are today.
Best of Us Investors presents Kerry Griegmeyer.
Kim Croissant is a very well-known volatility trader. He has an advisory firm that basically advises big institutions, along with, I think they trade their own book of business, but they trade volatility and they create hedging strategies and all these different complicated things that probably 99.99% of the people who invest in the market have no idea what he's doing or even what he's talking about. But he's become a pretty prominent figure on CNBC because of his unique understanding of volatility and how it relates to markets. And so I've been following him for a year, maybe a couple years now. And I learn something every time he talks. And he said something yesterday that when he said it, I was like, what? But it totally makes sense. And what he said was the Fed is selling calls to the market, which is suppressing volatility. Now, that's not a direct quote. It's a summary of what he basically said. But it got me to thinking about what the Fed has been doing since March of last year with raising interest rates, along with trying to unload their balance sheet of roughly $9 trillion at its peak, and how you would go about doing that. But also, from a political standpoint, what the Fed, by suppressing volatility and unloading this and causing the market to go up, is from a political standpoint maybe favorable to Biden and his administration. First of all, let's just talk about the mechanics of buying and selling a call, a put, a stock, a bond. There is, for somebody who wants to buy, in this case, a call, they go to a market maker, and that market maker makes a market for it, meaning they sell a call to that individual. Okay, so what happens is then that individual hands over money to that market maker, and that market maker then is liable in the call situation that they will provide that stock at the strike price that it was bought at. And in exchange, they are paid that premium for that option or that call option, and that helps offset some of their risk. Now, it is often said that the Fed, the government, will come in and basically become the backstop to markets. And we've seen that throughout history. Back when the long-term capital management blew up, it was a major hedge fund. Back in the 90s, it was littered with all of these Nobel Prize physicists and economic guys, and they had created one of the biggest, most successful hedge funds up until the point they got basically caught between a Russian ruble and an Italian lira trade, and was triggered by the Asian crisis back in the late 90s. Go look it up. Company's called Long-Term Capital Management. But what happened was the New York Fed stepped in, helped dissolve the situation by coming in and taking over their book and allocating that book out to many of the different banks and brokerage houses within Wall Street. They've also been said to come in and backstop markets during the financial crisis, the dot-com bubble, the COVID crisis, the pandemic. This is their way of basically creating liquidity in the market and stopping things from happening that could be really bad for the overall economy. So when Mr. Carson says the Fed is selling calls to suppress volatility. What it's part of the thing that got me to thinking was, well, what is the Fed's what is their path? What is their mission right now? One, they're trying to stop inflation. How do you stop inflation? Well, you raise interest rates. You raise Fed funds rates, which they have. Right now, you're at about 4.5% on the Fed funds rate. And it looks like in all the talk is basically indicating these guys are going to go over 5%. They're going to raise them to maybe 5.25%, 5.5%. I've heard other people, experts in the know, say you could see another 300 basis point move or 3% in addition to the 4.5%. That would put the Fed funds rate at 7.5%. That's crazy, because that relates to how you borrow money and the money you borrow as when you want to get a mortgage or so on and so forth. So the other mission they're on is to unload the $9 trillion on the Fed's balance sheet. Well, how did they get $9 trillion? Well, they basically during QE, quantitative easing, or during the financial crisis, they came in and put money into the market. And the way they did that was to go and buy bonds or debt. So, for instance, mortgage debt, mortgage debt, student loan debt, car loan debt, anything. And they just slowly bought it. Well, COVID hit, or the pandemic hit, and they went in big time. And they started buying even more debt. And what that did was, in exchange for buying that debt, they gave money and put money, US dollars, into the system. What did that do? Well, that put the $1,200 paycheck, monthly government check into your pocket from 2000 to 2022. That helped prop up markets. That drove the dropping of Fed funds rates, made mortgages more affordable. I mean, I've heard people who refinanced their homes below 3%. What that created was, we had basically 80 or close to 80% of all mortgages out there have been refinanced below 4%, which is killing the housing market now, or the mortgage market, because nobody needs to refinance. And that's a big part of the mortgage industry. That's a big part of the economy when people refinance their mortgages. Well, with mortgage rates over 6% right now, it makes no sense to refinance at that level unless you're financially need to. So what does this mean with those two things? Right now, what the Fed is doing is they're taking those bonds that they have bought, all that debt they bought, to create liquidity in the market. Now they're selling it back off, or they're letting it roll off, meaning mature as time goes on and bonds hit maturity date. They're letting that roll off. Well, what's another way to bring money back into the Federal Reserve? It could be selling calls, basically saying to their prime dealers, hey, Goldman, hey, Bank of America, hey, Citi, we want you to go out and we want you to sell calls on the SPY, the S&P 500 ETF, at 410. We want you to sell calls at 400. We will take that risk. We'll take that. And what they end up doing is they're driving volume in these these 0 days expiration options. And we've seen it since the beginning of the year. What is now, if you go and look at these, the volume on these options that expire, say today, the 3rd of February, it's the 3rd of March, excuse me, wow, that went by fast, didn't it? The 3rd of March, you'll see the volume on the 400 SPY calls and the 400 puts, or 399 puts. It's significant. It's 6 figures. In some cases throughout the year so far, we've seen 400 to 500 plus days in volume on these SPYs and Tesla. Tesla has been a high volume one. And when Kim said that in the Power Lunch interview, which I'm going to leave the link below in this video, it got me to thinking, is the Fed the one driving this market? Is it the retail investor? I don't think so. I think it's the Fed. I believe the Fed is driving this market because they're sucking liquidity out of this market. They're unloading their balance sheet. They are raising rates, and they're determined to normalize where the Fed stands when it comes to their ability to offset situations like the pandemic or the financial crisis. See, before all this started happening in the last, before they started raising rates, the Federal Reserve had nowhere to go to save the economy anymore because Fed funds rates were basically at zero. They're tapped out on their balance sheet, $9 trillion on their balance sheet. The only place they can go is in reverse. Raise rates, lower their balance sheet, suck the amount of liquidity or US dollars in the system, suck it out. And selling calls on SPY and Tesla and Nvidia and Microsoft and Apple and all these high beta, high tech stocks that are in the news a lot, this is the way they can do it. It's one of their three ways of resetting the economy, resetting the market, and resetting the liquidity situation that we have. It blew me away when I heard this. It blew me away when he said it, but it makes complete sense to me. Because the amount of movement in, say, Tesla year to date, I believe it's up 60-some% year to date, it makes no sense. Their financials look good. Their fundamentals look strong. Their investor day was a total bomb, but it doesn't make sense that a stock in basically, 60 days is up 50, 60 plus percent. Apple up over 20%. I mean, all of these companies, it doesn't make sense other than there is a manipulator in the market and they're using the option market to do this. And the only company or entity that has the power to move things like this is the Federal Reserve. And that's why I believe this market is just creating false hope, and eventually this will die off, and all of a sudden everything will come back down to where it's supposed to be.